Bharatji.
Good morning, Ramnath sir. Esteemed members, a very happy morning to all of you. I welcome you all for this session on 5610.2, which will be handled by our direct tax expert, CAV Ramnath sir from Coimbatore. I hand over the proceedings to President sir for his welcome address.
Hello everyone. Very happy morning to one and all. I hope and wish that all of you are in fine health and are happier than earlier. It gives me immense pleasure in extending a warm welcome to all of you to today's webinar. A very special welcome to the speaker of the day, C.A. Ramnath sir. Can you imagine a small clause of a subsection of a main section of Income Tax Act 1961 is capable of creating lots of controversies and confusions? Yes, precisely. Section 56, subsection 2, clause 10 does the same. This section has traveled a long way through various other sections. First, the deeming provisions were brought into the statute through 5625, then shifted to 5626 with few additions, then again shifted to 5627 with few more additions, and finally moved to 5610 with effect from 1/4/17. There are various issues in this. For example, receipt of any amount without consideration by an HUF from its members is outside the purview of 56.210 in the hands of HUF, being the recipient. However, whether the clubbing provisions under 64 is still applicable, what will happen when two partners bring their respective lands into the partnership firm as capital contribution at the respective book values? As per the capital gain provisions, the sale consideration as recorded in the books of accounts will be the final, irrespective of their fair market values for capital gain purposes. Assuming the FMV of such lands are much higher than book values, whether the firm will be taxed under section 56.210 to the extent of difference between the FMV and cost as regarded in its books. That means even before commencing any money-making activity, the firm has to shell out taxes. Whether such deemed value will be allowed as a cost at a time when the firm actually sells those lands. There are so many similar other issues. These points are only to highlight the complexity of 56.210. The speaker of the day, C.A. Ramnath sir, being an expert on the subject, will unveil many such issues and will also elaborate probable solutions. Happy listening, and over to Secretary C.A. Bharat Kumar sir.
Thank you, sir. May I now request CA Deepak Kutadia to kindly introduce the speaker.
For the opportunity, sir. Mr. C. V. Ramnath is a commerce graduate and a fellow member of the Institute of Chartered Accountants of India. He underwent his graduation in Government Arts and College from Coimbatore, Tamil Nadu in the year 1990 to 1993. He pursued his chartered accountancy during the year 1996 under Sri K.S. Palanisamy, a chartered accountant from Coimbatore. He cleared his CA inter and his CA final with a rank holder, respectively 33rd rank in intermediate and 43rd rank in final at All India basis. He is also a gold medalist at the Coimbatore branch level in CA final. Presently, he is a partner at K.S. Palanisamy & Co., a chartered accountancy firm based out of Coimbatore. He has 23 years of experience in handling audits of various corporates and non-corporate entities. He has also handled the appeals under Income Tax Act under the Income Tax up to the Income Tax Appellate Tribunals. He also handles corporate and non-corporate restructuring cases. He was a faculty for the CA Final Direct Taxes paper at Coimbatore branch for 17 years. He presented papers in direct taxes in seminars and conferences organized by various branches of SIRC of ICAI. He also addressed the students of various colleges on topics related to commerce, taxation, and several others. He is also a member in the academic and governing council of various educational institutions at Coimbatore in Tamil Nadu. He was a member of the editing team of the books authorized by Padma Shri awardee Shri T.N. Manohar for students on income tax law. Over to you, sir. The webinar is all yours. Thank you.
Morning to the President and other office bearers, as well as all the viewers. Very happy morning. Of course, very nice introduction as well as the input on how we'll have to go about on the topic by the chairman, president of the institution. So we will get into the topic proper. The provision of section 56 of section 2 clause 10 requires a little more in-depth study. Section 56, all of us know very well, is a section dealing with the residuary income under the Income Tax Act. So section 56 is a charging section which is charging income under the head other sources. Now in section 56 there are so many entries, and if you divide those entries into components or baskets after baskets, one segment would be coming as into one basket where the amount will be otherwise not chargeable under profits and gains of business or profession. Only then it will be chargeable under other sources. So if not chargeable under other sources, only then it is chargeable. It is not chargeable under business, only then it will not be chargeable under other sources. Whether my screen is available, President?
Yes, sir. Your screen is available, sir.
Okay, fine. Very good.
Yeah.
So only if it is not chargeable under the head profits and gains of business or profession, then only it will be chargeable under the head other sources. Now, there are a number of instances. Their interest on securities, income from letting out of plant and machinery, together with or without building, where letting is separable or inseparable, and labor welfare contributions received will fall under this category. Then, if the income is not chargeable under profits and gains of business or profession or salary, then it will be chargeable under other sources. That is only a scenario where you have given insurance policy proceeds. To that extent, it will come. And the last residuary scenario is if the income is not chargeable under the head, any of the four heads, then it will be chargeable under other sources. There are residuary categories. But the first scenario would be a scenario where
Ramnath, sir, sorry for interruption, sir.
Yeah.
Is the PPT on, sir?
Yeah, that's what I'm asking. Whether
Oh, sorry. PPT is not available on the screen,
Okay,
sir. I think
okay,
you have to share the screen.
Yeah, let me do it.
Sorry, sir. Yes, sir. Now it is available, sir.
Okay, fine. Okay, this is what I have just narrated. One is where PGPP not chargeable, then other sources. If it is not chargeable under PGPP or salary, then it will be chargeable under other sources. The residuary, a case where none of the four heads available, then it is chargeable under other sources. But there are instances where an item would be chargeable only under other sources. We will not have the choice at all. So under that we have 6 scenarios: income from dividend, winning from lotteries, etc., interest on compensation or enhanced compensation, forfeited amount received on account of transfer of capital assets subsequently forfeited, compensation for termination of employment or variation in terms of employment, receipt by closely held company for issue of shares in excess of the fair market value at premium, and lastly the sum of money or property received without or inadequate consideration. These are the cases where the SSE doesn't have a choice. The income has to be necessarily chargeable only under the head other sources. Out of these items, we will now pick up our discussion the last item, namely receipt of money or property either without consideration or for inadequate consideration. For sum of money, it will be only without consideration. For property, it could be without consideration or it could be with for inadequate consideration. Now, if you trace the legislative background of this section 56 clause, subsection 2, clause 5 or 6 or 7, and then 10 now, we would be able to gather certain instance, certain important information to understand how the law evolved over a period of time. Gift was previously chargeable to tax, and from 1/10/1998, gift tax was considered to be not applicable. It is not deleted or it is not abolished. That section 3 of the Gift Tax Act was made inapplicable from 1st of October 1998. The act still remains. So when that particular proposition was moved by the Honorable Finance Minister Mr. Yashwant Sinha, said any gift given on or after 1st of October 1998 would not be chargeable to tax under Gift Tax Act. But at the same time, it was so said in the floor of Parliament as well as in the memorandum explaining the finance bill that correspondingly section 56(2) will be proposed to be amended to bring this as taxable in the hands of the recipient concerned. So instead of taxing the gift on a donor based, it will be taxed in the hands of the recipient as a donor based taxation under the income tax law. But however, this gift not being chargeable to the person paying gift or giving gift came into the statute with effect from 1st of October 1998. However, the amendment proposed in section 56(2) did not find the light of the day on that day itself. It proceeded some more time. Therefore, in that interregnum period, gift is not chargeable either in the hands of the donor nor in the hands of the, it is not chargeable in the hands of the donee as well. But Finance Bill 2 of 2004 introduced that 56(2)(5), wherein it was so said that any amount of money received without a consideration for 25,000 exceeding 25,000 per occasion. So it is not per annum, it was per occasion started. And the para 102 of the budget speech of the Honorable Finance Minister in the floor of Parliament, by then Mr. P. Chidambaram was the Finance Minister, went on to say, honorable members are aware of the fact I abolished gift tax in 1997. Honestly, when 1998, when gift tax was abolished, it was Mr. Yashwant Sinha who happened to be the finance minister. But when it was introduced in section 56(2)(5), the finance minister was Mr. P. Chidambaram. But however, the budget speech said, honorable finance members are aware that I abolished gift tax. That gives an impression that the language was originally kept for Mr. Yashwant Sinha. But however, since it did not see the light of the day, the paragraph was kept aside, and when it was reintroduced, the same paragraph was copied and pasted in the budget speech. So it would give an impression that the copy paste issues are available even here also, in addition to what normally we see in our offices. So from 1/10/1998 to 31st of August 2004, the gifts given by the donor to the donee not chargeable in both the hands. But from 1st of September 2004, this became chargeable only in the hands of the recipient only when per occasion the amount received exceed 25,000. Until then, it was not liable. But it came to an impression that every occasion one can say 25,000. That means in 1 year, several number of instances can be coined and one can make number of instances to raise more money without being liable to be taxed under section 56(2)(5). Therefore, from 1st of April 2006, that underwent a change. That particular provision underwent a change to say the transaction of 50,000 exceeding 50,000 per annum in aggregate would be considered for taxation under this particular provision. So that 25,000 per transaction or per occasion got replaced by 50,000 rupees per annum in aggregate, but the recipient should be only an individual or HUF. So if a company received money or a partnership received money or an AOP received money without consideration, that was not liable to be taxed under 56(2) series. But only when a recipient happened to be individual or HUF and the amount so received without the consideration exceeds 50,000 rupees per annum in aggregate, then only the chargeability came in. But that was there from 1st of April 2006 to 30th of September 2009. From 1st October 2009 up to 2017, the scope of the provision underwent a change. In addition to sum of money received without consideration of 50,000 exceeding 50,000 in aggregate, two other classes came in. Receipt of immovable properties either without consideration or for inadequate consideration, or specified movable properties received without consideration or inadequate consideration would also be liable to be taxed. But here, interestingly, for the purpose of this immovable property, the applicability of 50,000 would be qua each property, whereas for sum of money, all instances we will have to aggregate and see per annum exceeding 50,000 would be chargeable. For specified movable property, all specified movable property received without consideration we have to aggregate. All specified movable properties received for inadequate consideration we have to aggregate. In each of the buckets, the numbers crosses 50,000 per annum, then only chargeability would arise. So now the class 5627 from 1st of October 2009 to 31st March 2017 had three aspects: sum of money, immovable property, specified movable property. In immovable property and specified movable property, we had further two subclasses to say received without consideration, received inadequate consideration. And the ceiling limit is very important. It has to be independently examined. And in addition to this, individual and HUF receiving either sum of money or immovable property or specified movable property from 1st of June 2010 to 31st March 2017, a firm or a closely held company, a company in which public are not substantially interested, receiving shares of another closely held company either without consideration or for inadequate consideration, then to the extent of 50,000 rupees per annum in aggregate, no problem. Exceeding 50,000 rupees in aggregate per annum, that would also be chargeable to tax in the hands of the recipient firm or recipient closely held company. So up to 2017, for an individual HUF, three items are considered: either sum of money received, immovable property received either for inadequate consideration or no consideration, specified movable assets received for inadequate consideration or no consideration. For a closely held company or a partnership firm, receipt should not be all this. It should be only shares of a closely held company, either without consideration or inadequate consideration. Each buckets we have to separately have 50,000 rupees per annum in aggregate. So this was the law up to 2017, that either individual, HUF, partnership firm, closely held company. For individual HUF, sum of money, movable, specified movable. Within the specified movable, shares and securities are available. Within the shares and securities, shares of a closely held company is carved out, and that alone is made applicable for a firm or a closely held company being a recipient. From 1st of April 2017, this recipient status based classification went away. Receipt by any person from any person. Sum of money, the same ceiling, 50,000 in aggregate per annum exceeding triggered. Specified movable assets without consideration separately 50,000 per annum. For inadequate consideration exceeding 50,000 per annum separately kept. For immovable property without consideration 50,000 separately kept. For inadequate consideration, originally the section said that should be separately 50,000 ceiling available. But from 1st of April 2018, either 50,000 rupees or 5% of the consideration, whichever is higher, shall be given as a basic limit. Over and above, if at all the number crosses beyond that, only then the provisions of section 56(2)(10) could get triggered. From 1st of April 2020, Finance Act 2020 increased this ceiling limit of 5% into 10%. So by Finance Act 2020, that ceiling limit of 5% got increased to 10%. So only either 50,000 or 10% of the transaction value, whichever is higher, that gap of inadequacy is beyond that, only then the provisions of 56(2)(10) would get triggered. Now, we have said for now after 1/4/2017, the recipient by the individual or HUF, etc., all we have got separately. All recipient by everybody gets covered. But the asset received should be either sum of money or it should be asset of in the nature immovable or movable. Within immovable, we have two things, either inadequate consideration or no consideration. Within movable also, inadequate consideration, no consideration. That means inadequate consideration, movable, immovable. No consideration, movable, immovable, cash. That is sum of money. So 5 separate categories are there. Now the exception, we have to be examined for all these 5 separately. The question of aggregation of all the 5 and applying 50,000 does not arise. For each of the 5 scenarios, we will have to have that 50,000 limit to be separately examined. So let us take this example. Mr. A has the following capital transaction. In the financial year 1920, he received cash gift of 40,000 per annum from an unrelated person. So that's a receipt of sum of money without consideration. He received jewelry as gift from his friend on his birthday, the FMV of which is 45,000. Now it is receipt of specified movable. Now you purchased shares, that is another movable, for 10 lakh rupees, and the fair market value of the shares as per 11U and UA on the date of purchase was 11 lakh 48,000. Now we had 3 transactions during the year. Sum of money received, that is less than 50,000. Receipt of jewelry by without consideration, the FMV of which is less than 50,000. Receipt of the shares being a specified asset for consideration, and the transaction value and the fair market value gap is less than 50,000. Now we will have to apply this 50,000 separately for cash. There is a question from one of the participant. I would like to know from the president whether we will take the questions at the end or.
Sir, I think we can take the questions at the end, sir.
Fine.
So that there will be flow of. We will note down the questions, sir. We are keeping the questions.
Or alternatively, in the questions could be placed in the chat box of these
Zoom.
YouTube also, so that Zoom or YouTube you can note it down, and after the session is over, we will be able to answer out to the extent time permissible.
Okay, sir. Yes, sir. Yes, sir. Yes.
Thank you. So the 50,000 ceiling needs to be applied for sum of money received, for movable property received without consideration, movable property received for inadequate consideration. We apply this 50,000 ceiling independently for these 3 categories. In the given case, each of them less than 50,000, therefore not liable to be taxed under 56(2)(10). Now we'll take another case where Mr. B received the following capital transaction during the financial year 1920. Received a piece of land from his friend by way of gift. The stamp duty value is only 45,000. Purchased a piece of land for 5 lakh. And stamp duty value of this 5 lakh 42,000. Purchased another piece of land for 7 lakh, where the stamp duty value is 7 lakh 40,000. Now it's all immovable property. For immovable property, please note that the ceiling of 50,000 should not be aggregated for all inadequate consideration related transaction, all no consideration related transaction. For immovable property, the ceiling of 50,000 is to be reckoned property wise. It is not question of aggregation as far as immovable property is concerned. So for each of the property, we will have to apply 50,000. And if that 50,000, if this 50,000 are less than 10% after 1/4/2020, from 1/4/18 to 2020 March 31st, 5% of the transaction, whichever is higher, if that ceiling is the inadequacy falls below, the question of taxability under 56(2)(10) does not arise. So keeping that in mind, if we examine this, for the first property, whatever gift he has received, it is less than 50,000 per that property, qua that property, therefore it is not chargeable to tax. The next property he received for a consideration which is less than the stamp duty value, but the gap is less than 50,000 for that property, therefore it is not chargeable. For a third category, 7 lakh rupees is the transaction value, stamp duty value is 740, the gap is less than 50,000, therefore it is not chargeable to tax. For each property, if you apply this percentage, then obviously each property is falling less than 50,000, therefore nothing is going to be chargeable to tax in the hands of Mr. B. We'll take the third example. Mr. C has purchased the following vacant lands as fixed asset during the financial year 1890. For a first transaction, the consideration paid is 100 lakhs. The stamp duty value is 106 lakhs. The difference, the inadequacy is 6 lakhs. 5% of the consideration, because it is financial year 1819, therefore 5% of the transaction value has to be seen. So 5% of the consideration on 100 lakh is 5 lakh. So either 5% of the consideration or the standard deduction, namely the ceiling limit is 50,000, whichever is higher permissible. So either 5 lakh or 50,000, whichever is higher allowed. That means 5 lakh or 50,000, whichever is higher, 5 lakh. But the gap is beyond 5 lakh, that is 6 lakh. Therefore, 6 lakh is taxable. The second transaction, he paid consideration of 50 lakh, whereas the SDV is 51 lakh. Gap is 1 lakh. 5% of the transaction value is 2.5 lakh. Ceiling limit is 50,000, whichever is higher, that means 2.5 lakh permissible. For 2.5 lakh, the gap is only 1 lakh. Inadequacy is 1 lakh. Therefore, it is falling well within 5% of the transaction value. Therefore, nothing is taxable. The third transaction, he purchased the property for 7.5 lakh. The SDV is only 7.75 lakh. The gap is 25,000. 5% of the transaction value is 37,500. Ceiling limit 50,000. Gap is only 25,000. Therefore, nothing is taxable. That last property, 60 lakh he paid, whereas 61 lakh 75,000 is the SDV. 1.75 lakh is the difference. Ceiling limit 50,000, 5% of the consideration 3 lakh, whichever is higher, up to 3 lakh. If there is inadequacy, no problem. So therefore, 1,75,000 is falling below 3 lakh. Therefore, nothing is taxable. But if we aggregate all the 4 transactions for that year, the total consideration paid by him is 217.5 lakh. The SD of all the transaction is 226.5 lakhs. The difference is only 9 lakh. If we apply 5% of the total consideration paid, it will be 10.875 lakhs. 10.875 lakh is falling below 9 lakh. But however, the assessee would not be able to take a plea to say 5% of the consideration is more than the difference and therefore nothing is chargeable. The particular provision goes to say that 50,000 or 5% of the consideration need to be tested for each property as far as it is relating to immovable property. So for immovable property, the aggregation principle would not apply. Sometimes it will be favorable to assessee, sometimes it will be unfavorable to assessee. But the principle here to be seen is for immovable property, we will have to necessarily consider property wise. Aggregation principle otherwise applicable for sum of money, otherwise applicable for receipt of specified movable without consideration, receipt of specified movable for inadequate consideration. For these 3 only, aggregation principle would apply. For immovable property, aggregation principle would not apply, and therefore for each property we'll have to consider. In the given case, property B, C, D, nothing is taxable, but property A, the amount paid as against the SDV gap is 6 lakh, which is beyond 5% of the consideration paid, and therefore entire 6 lakh would be chargeable. One may even go to the extent of interpreting the law to say up to 5 lakh the law anyway allows. Beyond 5 lakh it is chargeable. Why this gentleman should not take the benefit of first 5 lakh not chargeable and offer only 1 lakh as chargeable to tax? One can take a plea, but however, as of now we have no rulings to support the view. And of course, if an adventurous assessee would like to take a view, it's quite possible to take an argument like that. But as the law stands today on a plain reading, once the inadequacy crosses the threshold, the entire inadequacy would be chargeable to tax and not the excess over the ceiling prescribed. The inadequacy of over and above the ceiling prescribed alone is not chargeable, not the excess of 5% of the transaction value or 50,000, whichever is higher. Over and above, this alone is chargeable. The entire amount would be chargeable to tax. So, in nutshell, the exemption limit applies for all the 5 categories separately. And for immovable property alone, the law provides for certain concessions. Substitution of the SDV, stamp duty value, as on the date of agreement to the date of registration allowed, subject to satisfying certain conditions spelled out in 2nd and 3rd proviso to section 56.2, which is pari materia available to section 50C. And wherever there is a dispute of SDV, whatever relief otherwise provided in section 50C2, the same would be available in the hands of the receipt of property, in the hands of the person in receipt of the property, similar to what we have in section 50C2. Same thing would apply for 56.2 as well. And wherever specified movables are sought to be tested for its fair market value, we will have to apply 11U, rule 11U and 11UA to ascertain whether the transaction is at fair market value. and certain exceptions are provided in the section for applicability of the provision concerned. So to say, section 56 to 10 replaces section 56 to 7A to say categorically, now any person receiving from any person. Previously, individual HOF, all the 10 items, partnership firm and closely held company receiving shares of another closely held company. Whereas in the case of 56 to 10, the status based classification no longer applicable. Or any person receiving from any person would be chargeable to tax subject to satisfying the conditions spelled out in section 56.2. So closely held company, shares of a closely held company received by individual HUF normally would be applicable to tax. Under pre-amendment scenario, from firm or closely held company receiving it, again chargeable to tax. Any other person receiving this, not chargeable to tax. All other specified assets only for an individual HUF, a firm or closely held company receiving it, not chargeable. Any other person receiving it, not chargeable. Sum of money only for an individual HUF, for all other type of assessee, not chargeable. Whereas from 1st of April 2017, any person receiving from any person, all the specified assets and sum of money chargeable to tax. To appreciate this particular difference, we'll just pick up one small example so that the principle or the difference between these provisions prior to 17 March and post April 1st would be well appreciated. There was a scenario where a person has got a factory building, factory building, and a residential house property, all given to the bank for the purpose of obtaining loan for his business. And quite unfortunately, business did not go good, and therefore he was forced to somehow close the business and get rid of this liability. And bank said, you identify some buyer, sell off some assets, reduce your liability so that it will not be troubling you any longer. The gentleman was able to identify a buyer, and the loan was somewhere about 2 crore rupees, and he was ready to sell this factory land and building for 2 crore rupees, settle the liability so that he can bail out his residential house property given as a collateral for this business purpose. After all the deal was through, the parties identified that the guideline value, the stamp duty value of that land and building happened to be 5 crore, though the transaction was considered to be otherwise discussed to be settled at 2 crore rupees. The purchaser said, after discussing with his counsel, if I am receiving this property for 2 crore rupees, but the stamp duty value is 5 crore, as a recipient being an individual, I would be exposed to income tax under 56(2)(7). Therefore, I am not ready to get this transaction through. The seller's relative discussed this matter with me, and then I said, please understand section 56(2)(7) was applicable up to 31st March 17 only for an individual HUF. If the gentleman is going to purchase this property for a factory, anyway being a factory land and building, he is going to use it for his business. Please discuss with him whether he has any partnership firm in his family or a closely held company in his family. If he is going to purchase this property in the status of a partnership firm or a closely held company, provisions of 56(2)(7) would not apply. When this idea was mooted, they were very happy, and they purchased this property in a closely held company so that the difference between 2 to 5 crore was not exposed to tax in the hands of the buyer. However, for the seller, 50C would apply, but he had huge losses, etc., and the sale of this, some capital losses were there, so that he was able to get rid of this problem. But this status-based restriction available previously up to 31st March 2017 was helping SAC to decide to get out of these problems, at least if they choose the status properly. Wherever the chargeability came to individual HUF, but the transaction took place from one person to another recipient being either a firm or a closely held company or AOP, etc., that was somewhat helping the people to get out of it. But from 1st of April 2017, the language of the law goes to say received by any person. So therefore, that would definitely not help the SAC to get out any longer. From 1st of April 17, this by any person would definitely put the SAC into trouble. Wherever there is a genuine difficulty, the test has to be passed in an appropriate fashion. Otherwise, a general blanket exemption of choosing the status may not help the SAC to rescue from the problem concerned. Now, by any person is what the language of the law. Now, whether a person includes government is a question which we will have to see. Now, in the old judgment of the Andhra Pradesh High Court, Dredging Corporation of India, the court went on to say the person, the term person does not include government. So if a person, if any SSC receives any assistance from a government, can a view be taken to say person does not include government and therefore receipt from government would not be otherwise chargeable to tax under section 56 to 10. Something one can explore. But however, one also needs to take into account the amendment came in the definition of income, section 224. Section 2, clause 24 had an amendment from 1st of April 2016 that went on to say by introducing clause 18, any income includes any assistance in the form of subsidy or grant or cash incentive or duty drawback, waiver, concession, reimbursement by whatever name called by a central government or state government or authority, a body, agency in cash or kind to the assessee. It is treated as income. So if anything comes from government, maybe under 56 section 2 clause 10, the assessee may be in a position to argue that it is not received from a person. It is received from government. Government is not a person. But however, one has to equally test it by the amendment came in section 2 clause 24 subclause 18, which says any subsidy, grant, cash incentive, duty drawback, waiver, concession or reimbursement by whatever name called received from a central government, state government, authority, body, agency, either in cash or in kind, is treated as income. So therefore it is very difficult to sail through the proposition saying that money received from government may not be liable to be taxed at all. It could be tested under 56 to 10, but however under 224.18, it may get attracted and one has to see this. But the amendment came in 224.18 has got widest import. It has got a extraordinary ramification. Any subsidy received, any grant received, any cash incentive received, any duty drawback, waiver, concession, reimbursement received by the assessee from central government, state government or authority, body, agency, chargeable to tax as income. Now, we have been receiving gas subsidy from central government. The incremental component of the gas subsidy compared to the subsidy otherwise intended to be given was independently transferred. Previously, the price itself got factored. After some point in time, the price got to the market value, but the subsidy was transferred to the assessee's accounts as under a direct transfer of benefit scheme. So direct benefits transfer scheme, it was transferred. Now we'll examine the gas subsidy received in the context of section 2 clause 24 subclause 18, assistance in the form of subsidy by the central government to the assessee. So obviously section 224.18 would definitely trigger to the gas subsidy. Fortunate enough, circular number 19 of 2015 went to say the gas subsidy is not going to be treated as income in the context of 2 clause 24.18. So therefore it is not chargeable to income tax. Then received by any person. So the first controversy is person, which we have discussed. The second controversy is consideration. So received without consideration or for inadequate consideration. Now, what is the understanding we have to have for the term consideration? When Wealth Tax Act and Gift Tax Act was in vogue, the language employed was consideration in money's worth. But in 56(2), the language is consideration. Under income tax law, we do not have the definition for consideration. All the more we have only a definition for section 54F, net consideration. That net consideration definition also starts saying from the consideration, the expenses will be reduced for transfer so as to ascertain the net consideration. So there again, it starts with the word consideration. And General Classes Act also does not define the term consideration, but interestingly, we have section 2 clause D of the Indian Contract Act defines consideration. Of course, it says anything done or abstained from getting done, anything the promisor does or abstains from doing, anything the promisor promises to do or promises to obtain from doing, that act or abstinence shall be regarded as consideration or promise. So that means This is what is considered as consideration in the Indian Contract Act. There are several occasions where in the income tax law also the definition given in the Contract Act was imported. So now we have number of rulings given about the chargeability of a particular receipt in the context of capital receipt or in any other context prior to 2017 and in the context of section 56(2)(5)(6)(7)(7)(a). In that context, whether chargeable or not. But after 1st of April 17, by any person from any person, whether those rulings would survive or not is something which we will have to examine carefully. Couple of instances we'll take up for our appreciation of understanding of law. Amount received for not contesting the probate of will. Previously, the language 56(2)(5)(6)(7) or even earlier to that, the controversy was there. So if a person has written a will and passed away and the recipient of the will or the beneficiary in the will wants to get that probated, some other person intervenes and says the will is not legitimate, something wrong in it, and therefore I'll contest it. The beneficiary of the will says, okay, let us get into an agreement whereby I will pay you some money, don't contest it. Now this person is agreeing not to contest the probate of the will for which he receives the consideration. He receives some money, whether that amount is chargeable to tax or not. In the pre-56(2) series, it was considered to be capital receipt, therefore not chargeable to tax. Now, in the 56(2) series, we'll have to examine whether the capital receipt theory would continue to apply. Now, 56(2) per se generally taxes an item which is chargeable to tax. 56(2)(5), 6, 7, 7A, and 10 all referred to under the definition of section 224 itself to say it is chargeable to tax. So, therefore, the concept of capital receipt to the extent specifically included in 56(2) series would not continue to survive. So now we will have to test not only in the context of capital receipt, in other the touchstone of the provisions of 56(2) also we will have to examine whether it is chargeable or not. Now a person is receiving money for not contesting the probate. Under the Contract Act, not contesting the probate of the will is a consideration for receiving this money. So therefore here the money is not received by this gentleman without consideration. There is a consideration. What is a consideration? Abstaining from doing something. That is a consideration. So that is as good as consideration under the Contract Act as well as for the purpose of section 56(2)(10). Therefore, even today, amount received for not contesting the probate of the will is also not going to be chargeable to tax under 56(2)(10). Gift received from a parent company. Previously under 56(2)(6)(7)(5)(6)(7), only individual HUF was chargeable to tax. Recipient being a company, except where it is shares of a closely held company, it is not chargeable to tax. Therefore, in the olden days, money received as gift from the parent company by the subsidiary company was not chargeable to tax at all. But today, money received as specified assets received, immovable property received by any person, from any person, chargeable. The ruling per se with that principle may not be applicable. But now we'll have to examine the facts little further. If the parent company gives this gift to the subsidiary company to overcome the huge accumulated losses of the subsidiary company so that the subsidiary company would be in a position to pay its creditors and reduce the damage of the reputation otherwise going to suffer for the entire group as a whole, then to that extent one can say this is a consideration for giving this money. So the damage likely to cause to the group as a whole on the reputation of the group could be a consideration. But without all that, simply donation given or a gift given by the parent company to the subsidiary company may not, after 1st of April 17, be in a position to be argued to say not chargeable to tax, citing the judgment already given in the screen. Then comes working capital loan or a term loan waiver. Prior to 17, we had interesting judgments. First came Mahindra and Mahindra Bombay High Court judgment. Thereafter, we have number of judgments on this particular principle, and finally Mahindra and Mahindra endorsed by the Supreme Court. So that is on the context of term loan. So then term loan is payable periodically, but however the SSC finds some difficulty in paying it. So now bank and the SSC enter into an agreement to say one time some money is paid so that the balance outstanding will be waived. So there is a waiver of a portion of the loan. Now, if the portion of the loan contains an interest part of it, and the lender happens to be a bank, to the extent of the interest payable to bank added to the loan account, in the year in which it is added under 43B, it would have got disallowed because of non-payment. So waiver thereof is not going to trigger any income. In case if it is not going to be a banker covered under 43B, then under mercantile system, the amount so paid, amount so added to the loan account by way of interest would have been claimed as deduction in the hands of the borrower. So a waiver thereof would be triggering the provisions of section 41 clause, subsection 1. 41(1) says any benefit in the form of remission or remission or cessation of a liability is also chargeable to tax. So if it is going, if the lender going to be bank, obviously that interest claimed was not deducted in the year of passing an entry. Therefore, reversal thereof is not chargeable under section 41(1). To trigger 41(1), previously there should have been a deduction under income tax law. Previously, if it is not deducted, subsequent reversal would not result in any taxation. Now, the waiver is not only on the interest component, waiver is also on the principal component. For a principal component, 41(1) would not apply because principal was never considered as deduction while receiving the money. Therefore, reversal of the principal is not going to be taxable in the context of 41(1). Equally, under 28 clause 4, it is not going to be chargeable because it is not a perquisite or a benefit, it is received in cash. The waiver is only coming through cash. What received as a loan in cash is getting waived. So 28 also would not be applicable, 41 also would not be applicable. Therefore, Mahindra & Mahindra, Bombay High Court originally said it is not chargeable to tax, endorsed by Supreme Court. Now under 56(2)(10) or 224(18), whether it is going to be chargeable to tax, we will have to examine. Under 56(2)(10), waiver comes with a condition by the bank to say you pay X amount so that the balance will be waived. There is a one-time installment, OTS, or one-time settlement scheme, or in that one time itself, the settlement scheme may have multiple installment. If you comply this, the balance will be waived. And you do not comply within the stipulated time, waiver will get reversed. You are not entitled for waiver. So SSC and the banker agree for this proposition. In that case, there is a consideration for the waiver. For waiver, the SSC is agreeing to pay the balance amount in advance. So that itself constitutes a consideration. Since that's a consideration, waiver has got a consideration. It is not without consideration. Therefore, it is not chargeable to tax. Then one has to examine whether 224(18) would apply for this waiver. Assistance in the form of subsidy, grant, waiver, reimbursement, cash incentive, duty drawback, by whatever name called, from central government, state government, authority, body, agency, only 5. Bank, in my opinion, it will not come under central government or state government or authority, body or agency. Therefore, one can take a view that waiver would not fall under 224(18) also, and waiver would not come under 56(2)(10) also. Therefore, waiver of the loan would not be chargeable to tax. But we have slightly different view with reference to working capital loan. With reference to term loan, this view will continue to remain. With reference to working capital loan, we have slightly different view canvassed in various judgments to say working capital loan is given only to enrich the working capital of the organization. By waiver of the loan, the net working capital goes up. It's a trading receipt. Therefore, it's a business income. But in my personal view, the end use of the working capital by itself would not suggest the loan itself is loan itself is a revenue receipt. Loan is a capital receipt. Money received by way of a loan, being a capital receipt, could have been employed for augmenting a current asset. That by itself will not convert the loan from capital account to current account. But however, we have certain tribunal judgments to say working capital loan waiver would be considered as taxable, which has to be tested at the apex court level. And we have forfeiture of share application money. Again, it's a contract. There is a consideration. Therefore, it would not be chargeable to tax after the amendment of 56(2)(10), after introduction of 56(2)(10). And we have surplus resulting from assignment of loan to third party by making the net present value of the loan due. So in business world, some people could say, this is my remaining period of loan payable. I ascertain the NPV. I'll assign this loan to you. I will pay the NPV. The rest all you pay. So now, if at all we pay in installment, how much is payable. By ascertaining the NPV, how much we are actually paying, there is a surplus. Whether that surplus is chargeable to tax or not. And there is no pre-amendment, post-amendment, because of this making bullet payment only the waiver that particular surplus arises. That's a consideration for the transaction. It is not without consideration, it is with consideration. Therefore, it is not chargeable to tax. Asset or amount received by the partner upon retirement or dissolution of the firm. We have number of judgments to say that it is not without consideration. There is a contract. So therefore, with the consideration only it is received. Therefore, it is not chargeable in the context of without consideration. Whether it is inadequate consideration, with the consideration but inadequate, all that we will discuss separately when we are discussing 45(4), 50CA, etc. At that time, we will discuss in detail. Amount received by hospital to the patient account in response to public appeal. Slightly disturbing. The law would not have even imagined that such an amount of difficulty would come up where these cases when the law got amended in 56(2)(10). A particular person has got some accident and he is in the treatment. And the relatives make a public appeal in the newspaper to say, Mr. So-and-so is undergoing this treatment and his financial position is not so bright enough to take care of the treatment. So public can directly make remittances to the hospital account in order to prove the transparency of the transaction, and the money directly goes to the beneficiary's account. Hospital's bank account with this particular patient name, money can go. Now, how much ever is the hardship to this particular case, by applying the principle, now this particular money received is without consideration by a person from any person. Therefore, 56(2)(10) would apply. So even if the money directly goes to the hospital's account, still the provisions of 56(2)(10) could not be spared. Genuine difficulty, no doubt about it. But if applying the humanity, definitely this should not get triggered at all. But by literal interpretation, somebody has to test it. Obviously, in my personal view, this can trigger some difficulty in sailing through the provision. So alternatively, what one can do, this particular money so collected, instead of directly going to the bank account, it can be routed through a charitable trust interested and intended to help the people who are in need of medical facility. If the money comes to the charitable account, trust's account, which has got 12-year registration, and the money so collected is given by the charitable trust to the hospital on account of this patient, then directly 56(2)(10) would not get triggered to the patient account. For patient 56(2)(10), exception is provided that money received from a 12-year registered trust not chargeable. For a 12-year registered trust also, money received from unrelated party not chargeable. So that instead of directly giving credit to the patient's account in the bank account of the hospital, if the money comes through a registered charity, this can escape the rigor of the provisions which could cause unintended hardship to the patient's account when subsequently scrutiny starts for his case and subsequently some inquiry proceedings are started in his case. The next interesting development would be the corpus donation received by a trust. Prior to 1/4/17, we have number of judgments to say even if it's an unregistered trust, corpus donation is not chargeable to tax. Normally, section 12A registration is considered to be necessary for getting the benefit of corpus donation, because 11 subsection 1 clause D says any donation received by the charity towards corpus with a specific direction that it shall form part of the corpus of the trust will be considered as unconditionally exempt while deciding the application of income. That's what 11(1)D says. So in order to get the benefit of 11(1)D, it should be a 12-year registered trust. Only for a 12-year registered trust, this corpus donation concept is available. So in a trust doesn't have 12-year registration. In that case, whether corpus donation is possible or not. Prior to 2017 April 1st, if a person receives money, being an individual or HUF without consideration, it is chargeable. A trust, even though unregistered, not registered at is considered to be AOP. For receipt of money by an AOP, nothing is chargeable. Therefore, 56(2)(5)(6)(7) not applicable for a trust receiving money prior to 1st of April 17. Now, post 1st April 17, 56(2)(10) regime, corpus donation received by a trust unregistered under 12A or 12AA or 12AB, whether that would be able to say it's a corpus, therefore not chargeable. On a first side, one can say post 56(2)(10) difficult. But on a closer scrutiny, one can say corpus comes with a condition. The donor says you are expected to use these funds for this particular purpose. Till this particular purpose is crystallized, you are not expected to use these funds for any other purpose. So that means there is a condition. So the trust receives the proceeds for complying with that condition. So there is a consideration for receipt of this money. So one can be in a position to say corpus comes with a condition, therefore satisfying this condition is the consideration for receipt of money. Therefore, it is also with a consideration, not without consideration. But however, it is not free from controversy. It has to be tested. So prior to 1st of April 17, even an unregistered trust receiving corpus would be able to sail through under 56 to 67 as the case may be. After 1470, it has to be tested, but there is a silver ray of hope by interpreting the provisions of the term consideration. And we have amount received on family arrangement. Again, that again consideration is for giving up the rights which is already available. That itself is a consideration. Settling the pre-existing right in one form or the other is also a consideration. Lump sum alimony received under a degree of divorce, not willing to continue to live, itself is considered as a consideration in this case, and therefore it was considered to be with the consideration, therefore not liable. Amount transferred by a fiancé to fiancé on a promise to marry. That promise to marry is considered to be consideration, because law here says only consideration, not consideration at money's worth. Under Wealth Tax and Gift Tax Act, as we recall, already we have seen the language employed there was consideration of money's worth. Here it should be consideration, not necessarily money's worth. An agreement not to live together or agreement to live apart itself is a consideration, not necessarily money's worth. Still, that is considered as a consideration, and therefore it is not without consideration. Therefore, lump sum alimony received is not chargeable under 56 to 10. But a periodical alimony may be liable to be taxed. Camouflaging a periodical lump sum alimony into periodical or vice versa, facts only can explain as to how far you will be able to say lump sum made in installment, etc. Facts only should be in a position to advance the case of the concerned SEC. So similarly, this fiance to fiancé transfer with an agreement to promise or a promise to marry is also equivalent to satisfying consideration, test of consideration, therefore it is not liable. Then the next issue in this 56 to 10 is received. Received by any person without consideration. So person, consideration, received. The word received gives an impression at the first sight that receipt basis is only what is contemplated. All of us know very well section 145 permits the taxability under the head profits and gains of business profession or under other sources based on the method of accounting. So based on the method of accounting means either mercantile or cash. So if a person chooses to have a mercantile system, whether it is possible under other sources, answer is yes. Within other sources under 56 to 10, can a person say, I'll follow mercantile, though the language employed is received, therefore taxability would rise. Normally it would be other way around. And the revenue can say, though language is received, but if at all mercantile is followed for this source, definitely, even if it is not physically received, but the right to receive has accrued to you, it is possible to say it is deemed to be received or it is accrued under 145, it is chargeable. On a first choice, it may appear difficult to sail through this particular proposition, but a closer scrutiny of the provision, it may appear that the assessee wants to choose method of accounting for the purpose of this particular source of income. It is possible that a mercantile system could also be followed, though the language starts received, but still accrual is also possible by a conjoint reading of the second and third proviso to class B of section 56.2. Then three broad categories: sum of money, immobile property, movable property. For sum of money without consideration, money received chargeable. Earlier we had section 10 clause 3, gifts, that is casual income. Gift Tax Act was there, where 1974 a circular came to say gifts of purely personal nature not liable for Gift Tax Act, and it is not considered as casual income under 10 clause 3. That has resulted in so much of application of provisions, and 10 clause 3 deleted. That is no longer available in the income tax law. Section 1017A, awards and rewards from central government. state government or a body approved by central government, that also got proved. So now 10 class 3 no longer available. If a person receives money without consideration from anybody else, it is exposed to tax. If the money comes from central government or a state government or body or agency approved by central government, no problem. But money comes from various people. Let us take somebody is performing something good, a very achieving some scenario. Abhinav Bindra achieved something in Olympics. Appreciating him, various corporates started giving money. Whether the money received by him from those corporates liable to be taxed. And PV Sindhu got some money after achieving certain sports performance. Many people started paying, corporates started paying as a token of appreciation of their personal achievement, whether liable to be taxed or not. 1017A says awards, rewards from central government, state government, body approved by central government. Corporates giving these monies to these people achieving something in sports will not fall under 1017A. So whether that is chargeable to tax or not. 1974 circular was relied on by the courts to say this is not chargeable to tax even if it comes from the people. I have my own reservation on this particular proposition, but still there are judgments to say this particular awards received from other than central government, state government or authorized body is also considered as not taxable, since the circular of 1974 as of today is not withdrawn by CBDT. In 1986, another circular came from the CBDT to say whether these people receiving money would be chargeable to tax, and consequently payer is expected to deduct tax at source. In that context, the 1986 circular went on to say if these people are considered to be amateur professional and amateur sports people, not a professional sports people, then for amateur sports people, it is not considered as income, and consequently the TDS obligation does not arise. So if a person is not a professional sportsman, it is not considered as income by exercising his profession. Therefore, the recipient is not exposed to tax. Consequently, the payer is not expected to deduct tax at source. That circular even today remains in force. So even if the players considered, as long as they are considered as not professional players but amateur players, the circular helps them to say they are not liable to be taxed on the income, and the judgment went on to this circular is not withdrawn, 74 circular is not withdrawn, therefore it is not chargeable to tax in the hands of the recipient of the sports people. Recipient non-professional sportsman, it is not chargeable. That can come for the rescue of the SEC. The next bucket is immovable property. Now here, the language of the law is immovable property being, capital asset being land or building or both. Section 50C also uses the language land or building or both. 56 to 10 also uses the language land or building or both. But 269 UA, when it was dealing with acquisition of immovable property, categorically said immovable property to include any right or interest in an immovable property. Here section 50C as well as 56(2) uses the language capital asset being land or building or both. That means it is exhaustive, not illustrative. So either it should be land or it should be building or it should be both. Only then the provision would apply. So now interestingly, on a comparative reading of section 56 to 50C as against 216 UA clause D, there the definition of immovable property has got wider meaning to include not only physical land or building or both, also any right or interest attached to the land or building or both. In that case, here for 56(2), it should be a pure land or building or both. Any right should not be confined, is what an understanding emerges. In the context of 50C, also leasehold rights were considered to be not considered as land or building or both. But however, in the earlier days, developmental rights are considered to be not considered as asset for the purpose of 50C, subsequently considered as acceptable. So if one has to borrow the same principle, then what is considered as not pure immovable property, namely land or building or both, but only a right or interest in a land or building or both, it could not be chargeable to tax even if it is received for inadequate consideration or nil consideration, because it is not pure land or building or both. It is only a right or interest in the land or building or both. Now, originally when the particular proposition came in 2009, 1st of October, the language was saying only immovable property. So initially it gave an impression that if an immovable property is received either for inadequate consideration or for no consideration, the gap between SDV and the actual payment made would be chargeable to tax. Now we can compare this proposition. If the transaction happens to be an immovable property and the seller is transferring this to the buyer for a consideration, and the consideration is falling less than, it is something less than SDV. In that case, for 50C, the seller will be exposed as long as he holds that asset as a capital asset. For the purchaser, who is going to treat this as capital asset, originally it was not, so subsequently 56(2) would apply. If a person selling this land or building or both happens to be a trader or a businessman dealing with that land or building or both, 50C originally applied only to capital gain chapter. So it was not applicable to business cases. Therefore, 43CA came. So 43CA said if land or building or both is dealt with in a business transaction for a consideration less than the stamp duty value, the gap will be chargeable as business income. So effectively, when the transaction is of a business nature for a seller, 43CA will come. Non-business nature, capital transaction, 50C would come. Originally in 2009, the law was silent. So for 56(2)(10), either capital or current transaction for a buyer, it was exposed to tax. This was represented. Therefore, the amendment came in 2010 retrospectively from 1st of October 2009 to say capital asset only will be considered for the purpose of 56(2) saving. So if the recipient receives this land or building or both as capital asset, only then it would be chargeable to tax. If a recipient receives this as a current asset, it is not chargeable to tax under 56(2)(10). So the matrix goes like this: seller business, buyer also business. For seller 43CA, for a buyer nothing taxable. Seller capital 50C, buyer capital transaction 56(2)(10). So buyer current account transaction not chargeable to tax. The memorandum explaining the finance bill said the intention is only to tax the loophole came in the law, not to harass the SSEs who are otherwise efficient in the business in getting a good, a particular property for a consideration less than SDV. If possible for him to get a particular item at a price less than SDV by exercising his skill, that should not get penalized because of the provisions of law. Therefore, for a businessman, this is not considered as chargeable to tax. But the language employed is capital asset. Now, interestingly, the definition of capital asset is found in section 2 clause 14, which goes to say capital asset means property of any kind, whether or not connected with business, but does not include personal effect, which does not include certain items. Then inventory of consumable stores, spots, etc. Then rural agricultural land, that is agricultural land situated outside specified area. So that being the case, 56(2)(10) seeks to tax only the capital asset being land or building or both. If an asset being a rural agricultural land transferred by a seller to the purchaser at a consideration less than SDV, for a seller it is not even a capital asset. So long as it is not a business for him, it is neither chargeable under 43CA nor chargeable under 50C. Now for a person who is receiving it for business, 50C, 56(2) would not apply. If this rural agricultural land is purchased by the buyer for his capital transaction, it is not a capital asset within the meaning of 2 clause 14. Therefore, what is received is not a capital asset. Therefore, for him 56(2) should not apply. But however, for a contrary view, we have a Jaipur judgment in Trilok Chand Jain case. What does it say? The memorandum explaining the finance bill goes to say that current asset is not considered as chargeable, only capital asset is chargeable. That means the word capital asset should be understood to be in contrast to current asset. So long as the term capital asset is going to be encompassing rural agricultural land, it is considered as capital asset in the hands of the recipient, not as a businessman's perspective. Even if it's a rural agriculture and it is chargeable, the word capital asset should be understood in the context of not being a current asset, not within the definition given in 2/14 is what the way view canvassed by Jaipur bench. But of course, it has to be tested in future because the section 2/14 applies to the whole act. That being the case, the term capital asset should be borrowed only from the definition of 2/14 is another view which has to be tested in future. Now, 50C2 as well as 56(2), second class B, wherein we second and third proviso, provide certain relaxations. Now, first we'll take up one relaxation. Now, the SDV 1 crore, transaction value 70 lakh. Now, the buyer does not dispute the SDV for some practical reasons. He pays the stamp duty on the SDV. And those days up to 1st of April 2017, if the buyer happens to be other than individual HOF, there is no tax consequence, only stamp duty consequence. So stamp duty, buyer would pay, use the property for the purpose concerned. Now for a seller, buyer is not disputing on stamp proceeding. 1 crore is the SDV, actual transaction value 70 lakh. Seller is now in trouble in terms of section 50C. Now seller goes and says to the AO, the buyer doesn't dispute, but still I am of the view that 70 lakhs is the real value. The fair market value of the property is only 70 lakh. You refer this to the departmental valuation officer. Let him ascertain the fair market value. Now the 50C2 says the assessing officer may. Some cases where the assessing officer said it is my prerogative. The language of the law says may. Therefore, I may refer this to the VO. I may not refer to DVO. But as he said, when the buyer doesn't dispute and I'm asking you to refer to ascertain the real position, if you say it's a discretionary power for you and you don't refer it and you continue to hold that 1 crore is the SDV, which has to be treated as deemed consideration, I would be at the disadvantage. Therefore, you have to compulsorily refer it to DVO. Number of judgments came to say this particular term may used in 50C is to be regarded as shall. When an application came from the SSC requesting for reference to DVO, necessarily AO is duty bound to refer it to DVO. He doesn't have a choice. So the language may is now considered as shall, or rather converted into shall because of the court ruling. Let us keep this for a moment in mind. Now we'll come to the concession provided in 56(2) and 50C as well. Now, immovable properties are not transacted across the board on a very first day itself. Normally, time gap will remain between the date of understanding and date of execution. So, on the date of execution, on the date of understanding that this property would be purchased by the buyer from the seller, some price is fixed. On that day, the SDV is equivalent or somewhat nearer to, and parties are agreeing for it. Subsequently, the SDV undergoes a change because of the local laws. On the day when it is subsequently taken up for execution purpose, there is a variation in the SDV. Now, no fault of the buyer and seller. SDV underwent a change subsequently. That by itself should not put the people in trouble who have already agreed for a specified consideration. That is what second and third proviso to the provision says. In case already you have agreed for certain sum, subsequently SDV undergoes a change, that change would be disregarded and the SDV on the date of the agreement would be accepted, not the SDV on the date of registration would be considered, provided on the date of the agreement a portion of the consideration, either in full or in part, portion of the consideration is settled from the buyer to the seller at either through ECS or account pay check, not cash consideration. So on or before the date of agreement, a portion or full consideration is settled either through ECS mode or account pay across the check or draft. Then the SDV on the date of the agreement shall be imported to the date of execution, the SDV on the date of execution shall be disregarded. That is what the proviso says. Where the date of agreement fixing the amount of consideration for transfer of immovable property and the date of registration are not the same, SDV on the date of agreement may be taken for the purpose of this clause. Again, here also the language used is maybe. Can the officer say it is only maybe, therefore I would not? Now, few minutes back we have seen it's a beneficial provision under 50C. The court has said when the assessee makes a petition for reference to DVO, though the language employed is may, AO is duty bound. Similarly, here also it's a beneficial provision. Therefore, though the language used is may, we have to read it as shall, and necessarily it has to be important. Now let us take a practical scenario. In a state of Tamil Nadu on 8th of June 2016, across the board, the stamp duty, the SDV came down to 1/3. A practical scenario where on 1st of June, for 49,50,000 rupees, a particular property was considered to be exchanged or agreed to be sold. 49,50,000 is the price on 1st of June. 10 lakh is paid as the part of the consideration through account pay cross to check. 8th of June, the value came. On 1st of June, the SDV was 72 lakhs. Transaction value, market value 49.5 lakh. But SDV was on a higher side, 72 lakhs. 8th of June came down. 1/3 went up. 2/3. Now 72 became 48. Transaction value 49.5 and 10 was already advanced. 3 months time between the parties. After 3 months, it is sought to be registered. When the registration takes place, the SDV is only 48, transaction value 49.5. For 49.5, people paid stamp duty, transaction over. Now let us see. There is application of second and third provision. There is an agreement. Also, there is execution. On the date of agreement, SDV 72 lakhs. But on the date of the actual transaction, SDV underwent a change. Forget this change. As long as on the date of agreement, a portion of the consideration is settled through account pay cross check. On the date of agreement, 10 lakh is paid through account pay cross check. In that case, 72 lakh is the date on the date of agreement SDV. Can the officer now say on the date of agreement 72 lakhs is the consideration, the SDV, actual consideration 49.5. But you have satisfied the condition of second and third provision. Therefore, I'll disregard the SDV on the date of this registration. I'll consider the SDV on the date of agreement. Therefore, even though SDV on the date of execution is only 48, I'll put 72. You have sold only for 49.5 for people under 50C as well as 56 to 72 minus 49.5. Can we say I'm going to import? Not possible, because these are beneficial provisions. It should be used for the benefit of assessee, not for the revenue. So a benefit given by the act cannot turn itself to be obligation on the part of us. Supreme Court has, Honorable Supreme Court has mentioned in Mahendra Mills case, a benefit cannot become an obligation. A concession given cannot become an onerous responsibility on the part of the assessee. Therefore, the provision is being beneficial in nature, and therefore the provision is to be applied only when it is turning to be beneficial to assessee. A mere applying of this provision in letter as it is sometimes may result in undue hardship to assessee, where there is a variation in the SDV which has come down. That should not put the assessee in trouble. Assuming second and third provision is not there, still the assessee is not exposed to any tax because SDV is only 48 lakhs and transaction value is 49.5 lakhs. So by providing second and third provision, assessee should not be put into additional responsibility or additional liability. Therefore, being beneficial provisions, this should be read as only beneficial to assessee and not beneficial to revenue. Then the next provision is with reference to interplay between 45.3, 45.4, 50C and 56.2. So now 45.3 all of us know very well, dealing with transfer of capital asset by the partner to the firm, and 45.4 from the firm to partner. Chairman, you please let me know at what point in time I will have to close for questions.
Sir, I think you can continue for next 15 minutes. Then last 15 minutes, we will have question answer session, sir.
Because this is something where you can make good amount of additional points, but somewhere we'll have to draw a line. Therefore, another 15 minutes, I will give my presentation.
Okay, sir.
And afterwards, we will leave it for question answer session.
Okay, okay, sir.
Fine. So 45.3 talks about transfer of immovable property by the partner to the firm. And 45.4 talks about transfer of immovable property by the capital asset, not immovable property, capital asset by the partner, by the firm to the partner on account of distribution or otherwise, on account of dissolution or otherwise by way of distribution. Now, as the president has categorically mentioned at the beginning of the speech, now two partners are coming up and coming with an idea of pulling the landed properties and recording it in the book value or some indexed value where that minimum tax is paid by them in their personal status. In the hands of the partnership, what will happen under 56.2? Previously, up to 1st of April 2017, no problem because it is received by a firm. Only for individual if this section was applicable. After 1st of April 17, received by any person. Therefore, everybody would get caught. So all the type of SSCs would get caught, even in a partnership firm or AOP would get caught. So 45.3 only talks about the person contributing. 45.3 does not talk about the person receiving. For person receiving, we'll have to see 56.2. Received by any person includes partnership firm. For a consideration less than SDV, therefore it can be exposed to. There is one other school of thought. When 45.3 came in, because of a Supreme Court judgment went on to say that consideration is unworkable, therefore provision fails. Similarly, here also we can say for 45.3 only the consideration is specified. For 56.2 consideration is unworkable, therefore provision fails. A very good defense one can take, but in reality it has to be tested up to Supreme Court. So therefore 56.2 is operating on a different field. The same theory what we have applied prior to introduction of 45.3 could also be applied for 56.2, but it is contentious. So 56.2 may appear to be applicable. So 45.4 says distribution of capital asset by the partnership firm or AOP to its partner or member. 45.4 talks only about the distributing person. What will happen to the person receiving it? 45.4 is silent. So person receiving could be a partner or a member of AOP. Here again, 45.4 would apply for the person who is distributing. 56.2 would apply in the hands of the person receiving it. Now, 45.3, 45.4 would apply only for person giving it as capital transaction. 45.3 and 45.4 would apply only for a transaction which is of a capital nature. Now, a person has got some current assets with him. That current assets he gives it to the partnership firm as his contribution, not necessarily capital contribution. He gives as a contribution. Now, partnership firm receives it, no problem. Now, partnership firm also treats that as a current asset. Partner also gives this current asset to a partnership. The partner is already a jeweler, a person in the business of jewelry. Partnership firm also doing this. He gives a portion of the jewelry there. Now he gives us a current asset. 45.3 will not apply to him for a partner. Partnership firm receives this as a current asset. For that also, 56.2 would not apply as long as it treats as a current asset. Similarly, when a partnership firm distributes its current asset, not a capital asset, 45.4 would not apply. When a person receives this as a current asset, a partnership firm distributes as a current asset, and partner receives this as a current asset. There again, the provision would not apply because what is applicable under 45.3 and 45.4 is only capital asset. What is applicable in the hands of 56.2 is also capital asset. So when the transaction between partner and firm is in the nature of current asset, the provisions of 45.3, 45.4 and 56.2 would not apply. But interestingly, 50C also deals with capital. So capital transaction will get covered here and current account transactions would not get covered. There are a few other small aspects which under removed property baskets we will have to see. What is paid as, what is considered as income liable to be taxed under 56.2 would be considered as a step-up cost for the purpose of ascertaining the cost of that property for a subsequent round of transaction. But for the current transaction itself, it could not be claimed. Very interestingly, SSC took up this plea. He sold a property for 40 lakh rupees, where the consideration is 40, whereas the SDV is 50. And he has purchased another property where the guideline value is 50, but he paid that 40 and purchased it. Now he says, I've sold a property I'm entitled for 54 relief. I have purchased another property. For my calculation of 54 relief, first I will say consideration. You will say for 50 lakh is the SDV, 40 lakh transaction value. I'll start with 50. Less expenses for transfer, 0. Net consideration, 50. Cost, some amount. Balance, you have arrived. I have to reinvest this. In reinvestment, I have invested only 40, but the stamp duty value of 50 is 50. The balance 10, I am paying tax. Therefore, treat 50 as reinvested for the purpose of computing 54 or 54F or 54. In that case, court said, only when you sell this reinvested asset in the next round, this can be considered as the cost and not for the purpose of 54, 54B, 54F relief. You can consider as the invested cost. That is not permissible is what the Ahmedabad tribunal has said. And when the dispute in the SDV takes place in a stamp proceeding, whatever is final there would be considered. When the dispute takes place not in stamp proceeding, but a reference to DVO takes place, and the reference, whatever comes in final, will be considered. Section 50C2, whatever available is imported here, and section 155.15 also provides for relief there. Now, one has to be careful in dealing with this documentation part, because 56.2 provides for an exception towards relative, whereas 50C does not have any exception of relative. Now, father gifts the property to son. Gift is not considered as a transfer under 47. Therefore, section 45 would not trigger no taxability of capital gain. Son is receiving this property as gift. 56.2 would not come. 1 crore property. Father says, give me 70 lakhs. I'll give it to you. Now, for 70 lakhs, if it is given, for a son, STV is 1 crore, 70 is paid, difference 30, received from father, not chargeable. But for father, SDV is 100. So, sale took place for 70. For the balance 30, it will not be possible to say the balance is gift. Partial component of gift is not permissible under section 47. Therefore, when a person makes a sale, even if it in relatives, the 50C provision would apply for a seller. 56.2 may not apply for a buyer, but 50C would get triggered. Another troubling scenario would be when a property is purchased on auction from a bank. The auction price is less than the SDV, but however, highest bidder is going to get that. Now, person receiving this property from a bank and the consideration paid is less than the SDV. Strictly speaking, 56.2 would come. But consideration is the fair market value. Therefore, it has to be tested by seeking valuation to the DVGO, saying this is the highest price in the auction we have paid. That is the fair market value, so that within bank transaction, there is no on money paid. Therefore, 56.2 should not apply. Automatically, one would not be able to sail through. It has to come through the process of seeking reference to DVGO, etc. Now, the last basket dealing with movable property. All the movable properties are not covered. Now, only few shares and securities, bullion, jewelry, archaeological collection, drawing, painting, works of art and culture. Section 2 clause 14 says capital asset means property of any kind, whether or not held in business, other than personal effect, which does not include jewelry, archaeological collection, drawing, painting, sculptures, work of art. Apart from whatever is considered as non-personal effect, 2 other items are added here, namely shares and securities and bullion. So they are gelling each other. So they are not personal effect, sale of which would be considered to be chargeable under the head capital gains, and purchasing at a price less than consideration or purchasing from an unrelated person at a 0 price would be leading to tax under 56.210. So these are said to be 56.2.7 explanation D says means following capital asset. Property means following capital asset. That means it should be an exhaustive definition. So only these 10 items are covered. So motor car is not coming within this. Receipt of motor car for inadequate consideration or no consideration even from unrelated person, not chargeable. Plant and machinery, not chargeable. But of course, we have one tribunal judgment to say it is chargeable. A person selling from individual status to HUF status for inadequate consideration, the tribunal went on to say it is chargeable. But in my personal view, it requires reconsideration with utmost respect. Then transactions of a slum sale nature, where undertaking is shifted from one particular entity to another entity. Undertaking as a whole is not considered as specified movable, therefore it is not liable to be taxed. Any interest in partnership, interest in LLP, securities, securities as per 2H of the SCRA, which says any incorporated company or body corporate, therefore interest in partnership firm, etc., would not be considered as chargeable under 56(2)(10). Now, what interestingly one needs to see is 56(2)(10) vis-a-vis 50CA. When a closely held company share is transferred, like 50C, we have 50CA. Similarly, when a closely held company share is received, 56(2)(10) would get triggered. So, when a company in which the publics are not substantially interested, for a transferor, 50CA would come. When transferee, 56(2) would come. But if it is given as a gift, 47 says for a transferor, nothing is taxable. But transferee, 56(2)(10) would come as long as it comes from an unrelated person. So if closely held company share is given by a partner to the partnership firm, or widely held company share is given by the partnership firm to the partner upon distribution, provisions what we discussed for 50C, 45(3), 45(4), and 56(2) equally would apply, unless the transaction is of a current asset nature. If the partnership firm receives as current asset, partners also give as current asset. What they were already holding as current asset, they are giving to the partnership firm, or vice versa as current asset. This provision would not get triggered. The language employed in 56(2) is received by an SEC. The language is received, not transferred to an SEC, or received by any person. So therefore, it has resulted in some controversy as to, at the time of receipt of shares by the person from the company issuing share, whether the provisions of 56(2) would get triggered or not. If a person getting share from another person of share of another company, which is an existing asset, no problem. But when the company first time issues shares, that is first time coming into existence, in that case, whether it is chargeable to tax or not, is a question where the courts have gone to the extent of saying the language employed is received, not transferred. Therefore, receipt of share by a person from the company itself may be exposed to 56(2)(10), where person receives it at a price less than its FMV, or what otherwise could have been an FMV. But in a right issue, when everybody subscribes in the same ratio, nobody is renouncing. Ultimately, the sacrifice of everybody, nobody gains anything, nobody loses anything. Therefore, 56(2) would not come, even if the price is going to be less than FMV. If somebody renounced, somebody doesn't renounce. To the extent of not renouncing, he is not going to get anything. To the extent renounced, and that renounced share is purchased by somebody else, that other person gains something. To that extent, for him, 56(2) would apply. If somebody renounces, somebody gets that renounced share, but these two people are otherwise related within the meaning of that section 56(2) relative, then what you get from your relative only, since it's coming from relative, it is not going to be taxable. For bonus share, everybody is going to have the same ratio. Therefore, nobody gains anything, nobody loses anything, no problem. Buyback of shares, for a company, buyback of its own shares, nobody else share. Therefore, section would not apply. For a recipient, Section 34A would say it is not even chargeable. Buyback is altogether exempt. Now, when a company is under auction, the company has become bankrupt and IBC proceeding started, NCLT comes in, and then somebody intervenes and purchases the shares. In that case, you ascertain the fair market value of the share, but what is paid through NCLT is less than that. Whether provision would apply, definitely yes, but the fair market value, if you calculate under 11 UA, it could be more, but the amount is paid as per NCLT proceeding. Therefore, one can argue 11 UA should be giving way for the price determined through NCLT proceeding. As of now, the law doesn't factor this. One has to wait and see how it is going to be considered. Exception provided in the law is there is a list of exceptions provided. One is received from a relative. For a relative, there is no need for any occasion. Without any occasion, also the relative can. Interestingly, section 2 clause 41 also defines relative. Also, section 56(2) defines relative. We have section 13 defining relative, 80E defining relative. The definition given in 56(2) and 13(3) will apply to the respective provision, but 80E will apply to the respective provision. But whatever given in 2 clause 41 will apply to the remaining 10 places where the act has got the use of the term relative. For that, we'll have to borrow 241, 80E, 13(3), 56(2). The respective definition only will apply. 2 clause 41 would not apply. For an individual, a list of people are mentioned. And for HUF, any member thereof mentioned. Earlier, HUF was not there, so that individual was considered. Subsequently, for HUF, any member thereof covered. So the definition of 241 would apply for the remaining 10 places, not for 56(2). HUF, for HUF, the member is the relative. But when member receives from HUF, whether it is permissible or not, controversy started. HUF is a group of individuals where if all of them are related to that receiving individual, it should be allowed. One school of thought. Other one, money received from HUF is otherwise exempt under 10(2), and therefore it is not chargeable. So occasion is not necessary to be established for receiving the gift from the relative. This chart provides for the definition of relative for 56(2). So here, interestingly, one can see the descendant of brother or sister of the SSC or the descendant of the brother or sister of the spouse of the SSC is not considered as relative for the purpose of 56(2), but it is considered as relative for the purpose of 13(3). Similarly, brother or sister or their spouse of the father or mother of the SSC is considered as relative for 56(2), not for 13(3). So there is a difference. So interestingly, the law provides for the definition of relative within the income tax itself. For certain particular provision, one person is considered as relative. Few other provisions, they are not considered as relative. And this is very peculiarly drafted. Now, if I receive money from my uncle, my father's brother, for me, in the example SSC, father's brother is considered as relative under 56(2). Therefore, I am receiving from relative. It is not liable to be taxed. Alternatively, if I am giving money to my uncle, I will treat my uncle under the term SSC. SSC is my uncle. He receives money from his brother's son. Therefore, for him, I am not relative under 56(2). Therefore, whatever he receives from me is not charged, is not exempt from taxation. So for me, my uncle is relative. For my uncle, I am not relative. This is how the law comes up with. And interestingly, law says the descendant of the SSC, descendant of the spouse. Generally, descendant of SSC and spouse should be one and the same. There should not be variation. But we have peculiar scenarios in where the marriages does not subsist for a longer time, and of course, the issues come up, and therefore they separate, and thereafter remarriage takes place with somebody else, and issues are coming up. There, the first marriage son, for second marriage son, that is also considered as a relative, is what the law says. So a descendant of SSC, descendant of spouse, also possible. So it's what the law provides for it. We have a classic example in real life where one case has come where the people have done something, matter has gone to court, etc., with reference to civil and criminal liability. But there, this receipt of money by this definition of SSC's descendant, spouse, descendant also could be possible. Then other couple of examples would be occasion of marriage, will or inheritance, in contemplation of death, all considered as exemptions provided in law. But all these four, relative, occasion of marriage, will or inheritance, contemplation of death, section 68 to be triggered first, and thereafter 66(2) or 69 as the case may be, should be triggered first, only then 56(2) would come. Merely because 56(2) says it's exempt, one cannot say 68 or 69 should not be triggered. First we'll have to test it under 68, 69, 69A. After satisfying this only, we'll have to see. The language employed is on the occasion of marriage, not at the time of marriage. Some days prior to marriage, some days after the marriage, also considered as on the occasion of marriage. Not necessarily at the time of marriage, come a couple of days before, couple of days after, concerned with the transaction of marriage or event of marriage, it should be considered as exempt. And anything received by the bride or groom is only exempt, because on the occasion of marriage, the language is by the SSC. So the marriage should be for the SSC. Any money received by the father or mother of the bride or groom would not be qualifying for benefit. When on the occasion of marriage, relative is not necessary. Any unrelated person also can give. There are a few other provisions came in to say received by trust or from trust or registered under 28(10)23C is allowed, and corporate reorganization cases, because the word person includes company. Anything previously 47(4)(5), etc. not considered. Therefore, now the corporate reorganization cases also incorporated. Of course, these valuations, only one issue to say. In valuation, previously the balance sheet value is accepted as it is. Now in the balance sheet, if there is a specified movable or immovable, we'll have to again substitute that value and ascertain this value. and that should be on the date of transfer. For a closely held company, ascertaining the value on the date of transfer is difficult. We have one tribunal judgment to say from the last balance sheet to this balance sheet intervening period, based on the number of days, apportion the profit and ascertain the fair value. But that will be really difficult in case where there are so much of changes in asset, is something one has to factor. And lastly, last amendment came in 2019 to say sum of money received by non-resident is also considered as taxable by virtue of an amendment came in Finance Act 2019. Originally it was all the three, but only sum of money. Therefore, person paying money, treating himself as an agent, should use section 195 to deduct tax at source before making such payment to the other person. Any payment received by the non-resident from a person in India by way of other than related cases are exempt under 12A, etc. 195 is also to be factored, and for recipient it is considered as income, is what the provision says. So these are all certain important aspects one has to consider. Now I've exceeded 2 minutes more than what the president has allowed. I'll stop at this stage and we'll pick up questions if any, and then I'll leave it to the organizers.
Thank you, sir. Sir, you're not exceeded the time, sir. Actually, we started slightly late because of some issues in the YouTube this thing.
Okay, fine.
Yes, sir. Yes, sir. And I hope, actually, I think there are some more slides which we had to rush through due to the paucity of time. We had prepared so much. Sir. Can I take up the question, sir?
Yeah, please.
Sir, one question is, what happens in case of joint holders of property? Is the benefit of 50,000 available to each joint holder?
Yes, yes, absolutely. For each owner, each person, we have to ascertain that 50,000.
Okay. The next question is whether unsecured loan availed by company from director is waived by the director. Then is it taxable in the hands of the company?
Fine. Now let us again go back to the facts of the case and apply the provisions of 56(2) and also 224(18). Now 224(18) would not come for a waiver by a director to the company, because it is not a waiver from central government, state government, authority, body, agency. A director will not fit into a central government, state government, authority, body, agency. Therefore, it will not come under 224(18) as income. Finished. Now let us come to 56(2). Originally, when the loan was given, it was not intended to be waived. It was given with an intention to get repaid. Subsequently, for the reason that the company is not having adequate money, it is in very tight financial scenario, and the money could not be paid because so much of accrued liabilities, accumulated losses. So therefore, director, although different from company, to safeguard the interest of the other people, sundry creditors, employees, is ready to forego this. In that case, factually, when company is not a cash-rich company, it has so much of liabilities and risks. In that case, when the director is ready to forego, then this could be characterized as a consideration for not insisting on payment and waiver of the loan. In that case, it is considered as consideration for waiver. Of problems for that reason, even if you put the company into liquidation, all other people will take money, director will anyway not going to get. Therefore, he has waived it, at least to show a rosy picture to the balance sheet and then make some more financial position, getting possible or raising financial funds possible from third party is ready to waive. That could be considered as a consideration for waiver, and therefore it is not chargeable to tax. Next question, please.
If the hospital considers the treatment as free but get the money from different people, can the receipt be treated as income in the hands of the hospital so that the patient escapes the taxation?
Fine. Now, transaction, we will have to see the possibility of this all said and done, whatever way we would like to divide, etc. We have two Supreme Court judgments, Durga Prasad Moore and Sumati Dayal. Human probability test has to be applied. The hospital says I'm doing it free, then why should somebody make payment to this particular hospital? One side hospital says I have given everything free, also public appeal had come, they have paid money, I have retried it. So therefore, these are all something which we can say there is a planning possible, but by applying the human probability test, it is very difficult to say, hospital has not charged me, some philanthropic people on my account paid to hospital. So it is very difficult to sail through such cases, one has to test. By applying human probability test, these sort of cases may not find favor at a later stage. On sympathy ground, it can be considered, but technically it is very difficult to sail through. Ideal is to say, as I mentioned in the presentation, route it through a charitable trust so that controversy will not be there on tax front, and the person who has already suffered a lot, did not have money, medically heal, and he need not undergo this controversy and need not run pillar to post to get out of this.
Yes, sir. An individual from an international association in recognition of his personal philanthropic activities, will this be chargeable to tax in view of section 17, or would be exempted based on circular as mentioned by you?
The first part of your query, international something, was there is a gap. Can you read it?
Cash award received in foreign currency by an individual from an international association in recognition of his personal philanthropic activities.
Fine. Now, cash award received, section 17 would not get triggered because he is not an employee of that particular organization. But if this particular person is going to do this activity regularly and receives money, there is a very good chance that it is treated as a business income. In that case, receipt either from recipient being in India, receipt either from India or from foreign currency would be chargeable as business income. But if it is not related to his regular professional or business activity, something apart from that, then there is a possibility to say he would not get covered under business receipt. 17 would not come because he is not employee, and 56 and 28 would not come because it is not his regular business aspect. 56 has to be tested. The circulars in the year 1974 would come for the rescue to the SSC to say it is over and above his regular requirements. In appreciation of certain activities it is given. Therefore, 1974 circular can come for the rescue of the SSC. But all said and done, we have Foreign Exchange Regulation Act and Foreign Contribution Regulation Act to be verified practically so that they will not land into trouble in other law. Although we interpret section 56 to, in some other law, SSC should not get crossed.
Okay, sir. Sir, it was said that transaction in the nature of current asset would not attract 45.3 and 45.4. How do we demonstrate the nature of current assets?
It is all fact specific. Prior to contributing to the partnership firm, the SSC should be indulging in that particular activity. He should be able to demonstrate that he was previously dealing in that particular activity by showing books of account, balance sheet, etc. In the balance sheet, it should appear as a current asset 1 year before. Just before the date of introduction to capital asset, he opens a books of account, says I have introduced, and next day morning I decided that not to do this business, therefore I'm giving it to partnership. Definitely going to create a lot of controversy. By conduct, SC should be able to say it's a current asset for him as well as current asset to partnership.
Yes, sir. Sir, there is a case like there is a sole proprietary concern doing a manufacturing activity. There is another partnership firm. The proprietary concern is sold as a going concern to the manufacturing firm, and there is an agreement where all the assets and liabilities are listed. The closing stock also is transferred at the cost value. Whether the firm will attract 56 to 10, considering that there is a GP which is not considered while transferring the stock.
Fine. First question is we will have so many facets are there in this particular question.
Yeah.
First, when individual transfers his business as a going concern to the partnership firm.
Where, sorry, sir, sorry for interruption. That individual is not a partner in that partnership firm.
Doesn't matter. Subsequently, he can become partner or he can even get paid. The firm is acquiring his business. Could be any way. After acquiring, instead of giving money, they can be taking him as a partner for the amount otherwise due. Could be any way. But now, Mr. A, Mrs. A and company or Mrs. X and company, there are two SSCs. A is giving the entire business as lock, stock, barrel, going concern. To Mr. X and company, partnership firm. In that case, the item dealt or unit or a division. That is an asset per se. Section 2, clause 42C defines the term slum sale, which says if an undertaking, unit or division is transferred as a going concern, lock, stock, barrel, without specifying value of each asset and liability separately, vivisecting that liability or asset separately and then attributing value for it is not permissible. You'll have to calculate this only as slum sale. In that case, whatever price you are going to charge to the firm, that's your consideration. The net worth of the transferor undertaking will be computed in terms of section 50 capital B subsection 2 certified by the chartered accountant. And that net worth in the balance sheet, if you have depreciable assets, take the ITWDV. If you have inventory, take income tax declared inventory value. All other assets, ignoring revaluation, take cost and take the liabilities. Remove the liabilities. Whatever is the worth, over and above what you realize, in the undertaking unit or division, you've got more than 3 years. Irrespective of day before yesterday, you have purchased a large chunk of inventory. You have sold it today. Still, the entire amount will be considered only under capital gains. Concessional rate of tax is applicable without indexation. So therefore, when an undertaking as a going concern given to another firm, it is only under slump sale. Undertaking as such is not a specified asset. When undertaking as such is not a specified asset, under 56(2), what is received by the partnership firm is one full undertaking. So the consideration whether inadequate or adequate would not get tested when undertaking as such is sold. But if the tax saving there is going to be 3 crore or more, then GAR would apply. Otherwise, for lesser than the transaction, 56(2) cannot be triggered because undertaking is not a specified asset. When the price is paid for the undertaking as a whole, without saying for which asset how much, then picking up a portion of the price to the inventory and saying it is purchased at cost, not at with the GP. Therefore, it is purchased at a price less than FMV. That question would not arise as long as it is purchased as an undertaking as a whole. Value has to be fixed for an undertaking as a whole. And again, if the undertaking has got immovable property, for that immovable property we have specified value fixed for the purpose of stamp duty. That by itself would not go to say we have attributed value for one asset. The explanation below section 2 clause 42C categorically says attributing value for land and building for the purpose of effecting the stamp duty purpose, effecting the transfer under registration act, would not by itself go to say you have attributed value for each asset separately. Ignoring that, if total undertaking is valued and price is fixed and paid, 56(2) would not come. Except where GAR one has to factor. Otherwise than that, this would not come.
I think there's a last query, sir. The applicability in respect of fresh issue of shares by a company at a price lesser than FMV. Of course, right issue is covered by Sudhir Menon, Mumbai Tribunal. I don't know what is the query.
Yeah, correct.
Yeah.
Right issue is covered by Sudhir Menon.
Bharatji, I think Sundarajan sir is raised his hand. Bharatji?
Am I audible?
Yes, sir. Now, yes.
Namaskar, Ramnath, Sundarajan.
Yes, sir, please.
Just one question on this NCLT. You were talking about shares allotted at the time of NCLT or any assets transferred at the time in the place of an NCLT also. The valuation has to happen according to 11UA or 11UA as the case may be. Don't you think that this is parallel to what you were mentioning earlier in case of a DRT? When I'm buying a property in DRT, when it is an auction, that's the same analogy does not happen in case of an NCLT also, because NCLT, it is going for a one-time settlement or various settlements. There are lots of creditors. One creditor is being given a property at an X value. It will be at a lesser than the market value also. There is a very possibility. Don't you see a parallel drawn between this NCLT and the DRT?
Obviously possible, sir. That is what the point is that in NCLT sells a property or NCLT invites a person to take the company by subscribing fresh shares because the existing share has no value because all it is already written off by way of accumulated losses. NCLT invites the fresh person to take over by paying some infusing capital at a price. But we ascertain the value of immovable property will be more. But nobody is ready to purchase this company with all the risk.
Exactly.
Therefore, somebody comes with a lesser value. The person receiving shares from the company, receiving it for a price less than the 11UA value. Whether he is exposed to is a controversy which I was highlighting. But one can always say the idea of this provision is only for attacking the people who are doing tax evasion. When the matter comes through NCLT or DRT, etc., there is no question of tax evasion. Therefore, going by the broader principle of the objective for which these provision came into statute, the price paid through NCLT order, it should be considered as fair value.
Should be considered as a fair value.
11UA should be disregarded.
Oh, that's what I was my thought of. If the president allows only one more question.
Please, sir, please.
It's difficult for me to type. That's why I'm just coming on the line, Ramnath.
Yes, sir.
We were talking about 1 second. I was just yeah. In the case of an unsecured loan waived by a director, we were talking about that it will not be coming for the purpose of what you call in the company's hands. It will not be liable for taxation under 56(2)(10). But don't you see that whenever the companies are being wound up, let us talk about strike-off companies. So whenever there are outstanding in respect of creditors by way of balance outstanding from directors, which we are showing as a waiver. But what happens is the income tax, they are taxing it as other sources.
Oh, fine.
What will happen? Leave alone this 56(2)(10) as the case may be. What will be the impact?
In 56(2)(10), in order to tax under other sources, it should find place in 56.
Correct.
In 56, other than business, giving loan and taking loan, money lending is not the business. If money lending is not the business of the director, it's a solitary transaction, it is not chargeable under business.
Okay.
And therefore,
no, leave it's not even a loan. For the time being, you forget it is a loan also. It's a syndicator's balance. We have been funding the company for quite some time, but one stage the company is getting wound up or struck up as the case may be. The only what happens is, as you see practically, the department asks for nil balance sheet. That is, they want capital on one side, on the other side only loss, and nothing else for the purpose of striking off. Whereas there is a credit balance outstanding in respect of the particular party. The credit will be adjusted, P&L account will still be a negative only. That we can give it in the balance sheet. But there is every possibility the income tax office to pick it up as a case and levy a tax. Is it a fact? Is it a possibility or not?
Fine, sir. Now the credit balance, now from the viewpoint of the person who has lent money or advanced money, or it's a taxability issue in the hands of the company. We will divide.
Company. I'm talking about company. Yeah.
Now, if it is a company, there are huge accumulated losses.
Correct.
Because of that only it is getting wound up.
True.
The creditor emerged only during the course of the transaction of business.
Correct.
So the credit transaction, if at all it is reversed and treated as 41(1), reversal thereof, it's a business income. Business loss brought forward can be set off against business income.
MAC.
Now, if you give credit, there is a huge accumulated losses, then to that extent, as long as there is no MAT liability, no problem. If
that's the only test. That is the only test.
Now, assuming for a moment the business loss is less than the depreciation loss, and after giving this write-off also, business loss is absorbed and still something is there, MAT has to be examined. So
to some extent, MAT has to be examined.
MAT is possible. And of course, that is a scenario where if 2020 March, if they have opted for 115 BAC, etc., MAT would not come. Depending on how the scenario would take place, we will have to see.
Yeah, thank you very much.
Yes, sir.
Is there any more queries?
I have listed on all the queries. I think there are no more queries, Bharat sir.
Fine, sir. So we come to the end of this session. The pleasant task of vote of thanks, I'll begin now. Special thanks to the speaker, Sir Ramnath sir from Coimbatore, who has spared his valuable time on a Sunday morning with an excellent presentation and a very lucid way of interpreting the provisions and clearing all our doubts. Even also giving time for resolving the queries which have been posted by the members also. Sir, our sincere thanks for your efforts that you have put and readily agreeing for addressing our members. I also thank all the members who have participated in this session, and I thank you all for being here with us. We'll meet for the next meeting. Thank you.
Thank you very much, sir.
Thank you everyone. Thank you all for the patience.
Thank you, sir. Thank you.
Sir, can you leave the PPT presentation?
Yes, sir. We will circulate it, sir.
Okay, thank you. Sir, thank you, Ramnath sir. It's very excellent.
Thank you. Thank you so much, sir.
Meeting.